Dear YouTubers, welcome to Real Turkey channel. I am Atilla Yeşilara, your host this week. There will be other hosts, don't worry about it. Just give me more time. In this episode, I'm going to talk about Turkey's monetary policy, which is fascinating and unique in the world. Since July, Central Bank of Turkey reduced its policy rate by 1,000 basis points. Yeah. I'm not making a mistake. You didn't mishear me. Central Bank of Turkey reduced its policy rate by 10%. 10 percentage points. A lot of emerging markets, nations, their central banks are reducing policy rates because Fed is reducing rates and European Central Bank is going deeper into negative rates territory. Bank of Japan is a lost case. I'm not even going to talk about it. But Turkey has gone way overboard in terms of interest rate cuts. So I'm going to discuss the question of whether these rate cuts are trickling down into the economy. Now, obviously, anyone who has studied some economics knows that monetary policy works with lags, and the length of these lags is uncertain. Sometimes they are as short as 6 months. That is, it takes 6 months for a certain monetary action to show some results on the economy. Sometimes they are as long as 12 months. In Turkey, these lags tend to be shorter, simply because Turkey is a more myopic economy. In the United States and Germany, just to show two examples of advanced economies, plans are made on 10-year and 30-year interest rates. Here, we're usually planning on 3-month and 2-year interest rates, so the lags ought to be shorter as well. The first rate cut was made in July, so by now we should see some effects, positive effects. Are there? Are the rate cuts trickling down to the economy? The answer is yes, no, maybe, I don't know. Okay, well, believe me, it's gonna get better. Just bear with me. The reason why I can't give you a certain answer is simultaneity. A lot of things are happening at the same time. One thing that's happening in tandem with the central bank loosening monetary policy is extremely loose fiscal policy. And I've thrown in some graphs there, most of which is not related to this. But anyhow, they're fun. Just a lot of, action. Whoops. So, take a look at them. Fiscal policy also has extremely been loose, and fiscal policy usually works faster. And in the short term, it's more effective than monetary policy. In September, for instance, the nominal non-interest expenditures of the government rose by 20% year on year. Remember, inflation is something like 10%. So the government is spending a lot on the people. And the non-interest deficit rose roughly by $7 billion year on year. So a lot of income is being injected into the economy. That distorts the effort to measure what the central bank is doing to the economy. Nevertheless, we do see some pickup in the confidence surveys of October. There are 5 of them: consumer confidence, manufacturing industry confidence, and then the 3 sectoral indices: retail, services, I have no idea what services contain, and construction, all of which increased on a month-on-month basis. And I tend to give some credit to the July interest rate cuts. Nevertheless, given the fact that some of the credit is deserved by fiscal policy and the improvement in October sectoral confidence indices is rather weak, I would say for the amount of rate cuts, we have received very little bang in the economy. Allow me to explain. The consumer confidence index for October rose to 57 from 55. The separating line between consumers feeling good and bad is 100. So an increase from 55 to 57 is like you're in a deep coma, but now you are blinking your eyelashes. Who cares? Construction industry is dead. Construction industry confidence rose by 8 points from 52 to 60. Again, who cares? There's no construction activity. Retail is good. It rose to 102. Retailers are positive, and I can't deny the fact that people are spending. That's good. In terms of services, the level is good, but if you look at the details, service providers, whoever they are, I have no idea who these people are or what the service confidence index covers, are rather pessimistic about the level of demand in the next 3 months. The same thing applies to manufacturing industry. The participants in the survey are rather cautious about the level of demand for their goods in the next 3 months, and they certainly don't intend to invest into new capacity. Oh, by the way, I'm going to eat one of these delicious homemade cookies that my life partner, wife, whatever is the term now used in the West. So all in all, some improvement. You may say, and you'll be perfectly correct, wait, you said there are lags. I mean, these are only the July rate cuts you are talking about. There had been two more rounds, and eventually you may see more improvement in the Turkish economy. Correct. I cannot deny that. But there are two factors which make me think that October was probably the best. First, in the previous video, somewhere around here, I mentioned the 2020 budget, which is a consumption killer. It levies so many new taxes on households that for them to pay these taxes and to consume more is almost impossible. Even though I didn't talk about it this week, last week I broadcast a video called "I Expect a Major Sell-Off in Turkish Assets." Watch that again. It didn't happen last week. But the underlying idea of United States Congress contemplating sanctions and Turkish people, Turkish savers, switching to FX deposits, that's a run away from Turkish lira, are still valid. And of course, another currency shock immediately leads to higher inflation and to an earthquake in corporate balance sheets. Turkish corporates are heavily indebted, and a reduction in employment and fixed investment spending, thus slowing down the economy. So even if central bank rate cuts have trickled down just a smidgen into the economy, other events demonstrate to me that this effect is not permanent, and whatever growth we have achieved in October is not sustainable. Thank you very much for listening to Atilla Yeşilada at Real Turkey channel. Subscribe, watch, or do both. Bye-bye now.